This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 515 was produced on January 15th, 2026. I'm Eric Townsend. Commodity Context founder Rory Johnston returns as this week's feature interview guest. Rory and I will discuss all things crude oil, starting with the Venezuela news and what it means for markets, then moving on to Iran, the U.S. Strategic Petroleum Reserve, and much more. This interview was recorded on Tuesday afternoon, so it doesn't include commentary on the whipsaw in oil prices that we saw on Wednesday afternoon, which was attributable to President Donald Trump changing his statements about his intentions relative to military intervention in Iran. Be sure to stay tuned after the feature interview for our Postgame segment, when we'll have Patrick's Trade of the Week plus our latest perspective on all the major markets.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, January 14th, 2026. The S&P 500 index up 7 basis points, trading at 69.26. The market continues grinding in a broader sector rotation. We'll take a closer look at that chart and the key technical levels to watch in the post-game segment. The U.S. dollar index up 32 basis points, trading at 99.05, retraced back above its 50-day moving average, begging the question, is this a bounce or a reversal? The February WTI crude oil contract up 1,070 basis points to 61.88, a material jump in oil prices off the supports of 2025 lows. The March WTI crude oil contract up 1,070 basis points, trading at 61.88, a material jump in oil prices off the support of its 2025 lows. The March RBOB gasoline up 814 basis points, trading at 186. The February gold contract up 388 basis points to 46.35, pressing 52-week new highs, many asking if 5,000 is the next stop. The March copper contract up 324 basis points, trading at 605, which is also pressing new highs. The January uranium up 183 basis points to 83.45. Then the U.S. 10-year Treasury yield down 1 basis point, trading at 4.14. The key news to watch next week is the core PCE price index, the U.S. final GDP, and the flash manufacturing and services PMIs. This week's feature interview guest is Commodity Context founder Rory Johnston. Eric and Rory discuss President Trump's oil price strategy, sanctions-driven supply bottlenecks from Venezuela, Iran, and Russia, geopolitical risk premium, and what the forward curve and time spreads are signaling for crude traders, and more. Eric's interview with Rory Johnston is coming up as Macro Voices continues, right here at macrovoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Commodity Context founder Rory Johnston. Rory, boy, we live in interesting times. We've got the situation in Venezuela, and I think a bigger picture to talk about, which is overall, President Trump has described an agenda which is, hey, we've really got to get oil prices down. It's very near and dear to his heart because it's one of the most important things for him to do in order to secure the potential of not losing the House in the midterm elections. How would you score the president in terms of using the best tools available to him to bring prices down?
It's a great way to kick it off, and thanks for having me back on the podcast, Eric. 2026 is off to quite the start. So this question about Donald Trump and using the various very real levers of the presidency in order to reduce the price of oil, I would say that the president's actually been really, really bad at this to date. I think if the president did nothing, the oil price would be considerably lower today than it is right now. I think it's important to kind of walk through why that is, because I think that's actually a fairly this is a claim that gets me a decent amount of hate online, that people are like, no, of course, like, listen to what Donald Trump says. He clearly wants lower oil prices. And look, he just, conquered Venezuela in order to get lower oil prices. What are you talking about? But what we've seen is that, one of the things we've talked about, routinely, I think that we talked about this last time I was on the podcast, that the global oil market has headed in 2025, particularly the latter half of 2025, into fairly pronounced oversupply, at least on paper. That supply considerably outran demand by upwards of 3 million barrels a day, which is, for those that watch the oil market, a very, very large glut in the oil market. But while prices have been broadly under pressure, they are by no means under the degree of pressure you'd expect if that kind of surplus was bearing down on stocks. And well, there have been a couple different things that have kind of prevented, I think, the full transmission of that glut into prices and term structure so far. I think undoubtedly the most important variable there has been President Trump's considerable increase in both the volume and enforcement of various sanctions throughout the oil market, both on Venezuela, on Iran, and on Russia. And across all three of these countries, you've seen considerable buildups. There's essentially really two ways you can judge the efficacy of these sanctions. And that's by observing both the price that these producers are getting, or essentially what price their crude is clearing the market, and also looking at oil on water, essentially how much are their logistics getting backed up. And oil and water has surged through the latter half of last year. And in the last quarter of last year, so Q4 of 25, you were building oil and water at a pace of around 750,000 barrels a day across the three of those sanctioned producers. That's a lot of oil. And that alone takes almost a third of that supply glut right off the market. And I think even though people will say, like, look, their barrels are obviously being produced, which is true, but they're not. This is the difference between production and supply. They're being produced, they're ending up on tankers, but they're not actually available to supply any piece of the market. So you're getting that kind of double whammy of it not happening and also kind of rising on the side. So this is preventing or blunting that supply from hitting the market. And that, I think, is the most direct way that the president has actually affected the oil market to date, is essentially by taking off a bunch of supply that otherwise would have been there. So to that point, I think that if you're grading him on his ability to keep oil prices low, I would say he has been, to date, a bullish factor on oil prices. And prices would be much, much lower if Kamala Harris had won the presidency, because presumably she would not have been quite so harsh on various angles of this sanctioned kind of buildup.
Now, one of the counter arguments that you would hear to what you just said is, Rory, haven't you been paying attention to the news? President Trump just announced that Venezuela is about to hand over 32, maybe as much as 50 million barrels of oil right away, which has got to help the market. Rory, does Venezuela have 50 million barrels of oil to hand over to Donald Trump?
Yes and no. And I think it really depends on how we define what we're looking at. And Eric, I think you and I actually interacted earlier this week, or I guess late last week, on this question of like how much oil is actually floating around out there on Venezuela. Because we were talking earlier about a lot of Venezuelan oil backing up on water. That's, I think, a piece of what the president has talked about seizing, his, what I've called his kind of like pirate booty of his conquest of Venezuela, is this 30 to 50 million barrels. Now, one of the things, and I think when you look at what he's said, it's very clear that, at least in the president's mind, part of what he will be grading himself on, and I think what we should also be grading him on, I guess, is whether or not Venezuela's oil production actually begins to recover. He's basically said that Venezuelan oil production, the industry is essentially rotted away for lack of foreign capital and because of domestic mismanagement, which is all true. So presumably he wants that production to rebound fairly quickly, which again goes to his claim of wanting lower oil prices. So one of the issues with Venezuela and the blockade that he imposed is that you essentially backed up a lot of pressure on those systems. And without tankers to get rid of the crude, and with domestic storage tanks overflowing, you saw more and more pressure for PDVSA, the national oil company, to shut in production, which is going the opposite way of what the president wants. So I think what Trump is saying or claiming here is that, while before they even figure out what's happening with all the sanctions and the blockade and everything else, we're just going to quickly take off that, 30 to 50 million barrels to relieve some pressure on the system. Now, you can cobble together very charitably a way to do this, but it's unlikely we're going to see that full volume of crude delivered to the Gulf. But I think regardless, markets are now, I think, acting in a way where that is beginning to show up in prices. You've seen, for instance, while global Brent crude markets, I think, are rising, rallying pretty aggressively, and the backwardation at the front of the Brent curve has turned decisively bullish again. WTI is lingering kind of on a weaker back foot, not quite able to get that same bid. And you've seen especially heavy pressure on things like Western Canadian Select or heavy crude oil benchmarks in the U.S. Gulf Coast, where essentially from November levels, you've widened from a differential of about $4 a barrel under WTI for WCS at Houston to roughly around $7.58 a barrel under WTI at Houston. So that, I think, is your evidence that there is some pressure coming there. But now we can get to the whole question of like, what does this mean for the future of Venezuela? And is this a problem for Canada? And these incrementally, I think the future of Venezuela is probably better without Nicolas Maduro at the helm than with him at the helm. But I think it's obviously much more complicated than just all of a sudden Venezuelan oil production is just going to start mooning going forward.
It seems clear, Rory, from both President Trump's comments and as well as Chris Wright's comments that the agenda is very clear here. It's going to be the government of the United States does everything possible to encourage U.S. oil companies, if not subsidize U.S. oil companies, to make massive investments to rapidly bring that production in Venezuela back online. And the thing that seems I guess, surprising to me is most of the other things the president has done seem to be temporarily focused on the midterm elections. Now, at least according to our mutual friend, Dr. Anas Alhaji, he did a podcast or I guess a Twitter Spaces about this. He thinks that the most aggressive, no matter how much money you throw at it, it would take at least 3 years to get just 1 million barrels per day of Venezuelan production back online. And I don't think anybody disputes that Venezuela has the more reserves than anybody else. So over a long period of time and a huge amount of investment, there's lots and lots of oil there. But Dr. Alhaji says at best it's 3 years to get just 1 million barrels a day of additional production. What's your take on that? Does it take that long? Does it take less than that, longer than that? What do you think?
No, I think that's about right. I think one of the big questions is, where are you measuring the growth point from? Because I think one of the things that's happened with Venezuelan supply and production in the market is that it's changed a lot over the last couple of months. So, for instance, whether Trump could claim a much larger victory, a much larger growth pace, if you're measuring off the low point of shut-in production due to the blockade, right? Trump can just remove the blockade and some of that will just bounce back naturally. Now, if we're talking about, say, how can we get incremental growth from, say, October levels from before the blockade was really imposed, that I think is going to be a much harder sell. And I think that's where you're going to get 3, 5+ years before you can really get 1 million barrels a day of production. And again, this is with 50+ billion barrels of investment. This is with everyone beginning work very quickly or immediately, none of which is currently happening. But I do think that you can probably get a piece of that, say, 200,000-300,000 barrels a day, probably quicker than that, maybe a year, maybe 18 months. That would be mostly focused on Chevron's operations and essentially squeezing out what else you can get from the current system. But I think after that immediate low-hanging fruit is exhausted, that's when you move to this question of, okay, now we need to repair pipelines. We need to fully begin to refurbish fields. We need full workovers. We need all the other things. We need more diluent coming in the market. We need upgraders back up and running. This is when you start to get this really heavy, mountain of pent-up investment demand that has yet to be kind of satiated. And the further you go down, the harder and harder it gets, because eventually you run into things like, well, the Venezuelan power market, like the power grid, is deeply, deeply unreliable and prone to blackouts. That's not a good way to run upgraders and refineries and various other components of the industry. So when you get to that stage, that is obviously, you need to fix like the entire country's power grid. So these are obviously extremely difficult, expensive things to do. And that, I think, is where you're going to start to run into more pushback or reticence among the people and the companies that would be required to do that investment. I think you saw that this past Friday when Trump and Wright, et cetera, all had the collection of oil industry executives gather for this press conference about what the future of Venezuela was. And you saw a fairly broad spread. You saw everyone there. You saw everyone from upstream companies, service companies, refiners, trading companies, et cetera. And I think each of those had a very different view of how optimistic they were coming down the line. For instance, Chevron, which most listeners would know, has been in Venezuela, never left Venezuela, is able to work at a deal with the Chavez and then Maduro government, and was able to cut sanctions waiver deals with the Biden administration and now again the Trump administration. They think that, I think reasonably so, they can get it's all upside for them because they've held on against all odds to their Venezuelan assets. That, I think, will be some upside for them. But other companies like Exxon is the one that coming out of that meeting had all of the headlines about it, was kind of saying it was, the quote was that Venezuela in its current state is uninvestable, and talking about, the long, slow work of rebuilding institutions and rebuilding the rule of law and rebuilding a culture that respects contracts and kind of continuity of government. These are obviously much more difficult things and things that the president can't just like snap his fingers and say, voila. Other companies, I'm sure, trading companies are going to be all over this. You had Trafigura and Vitol at the meetings, were very enthusiastic about essentially acting as the White House's broker of Venezuelan, repossessed and resold Venezuelan oil. They're very enthusiastic with that, unsurprisingly. But I think refining companies seemed happy to have more heavy crude availability. But in terms of companies that were jumping over themselves to get in and really make those hard investments, no, that happens much slower. And then we get to this question of, okay, well, would you have subsidies? The one thing that they said in the meetings was, Trump committed to some quote security guarantee. But obviously, the next day, the State Department advised all Americans to leave Venezuela because of the security situation. So, there's a horse and a cart situation here, and I don't think the president knows which one comes first.
Let's go back in the short term to this 30 to 50 million barrels of oil that's supposedly about to be handed over. First of all, I think there's kind of a psychological effect that we're used to talking about oil supply in barrels per day of production. This is not per day. This is a one-time thing. So if we did hypothetically get 30 million barrels all at once, okay, that's 1 million barrels a day for just 1 month, and that's it. And so in terms of context, it's not very much oil. But even if we said, okay, 30 million barrels still, that's something to throw at the market, at least short term. Maybe that'll bump the price down a little bit and overcome some of the upside that we've seen in the last couple of weeks. But hang on, where is this oil? First of all, does it exist? And if it exists, where does it exist? Because from the Twitter exchange that I had with you and Dr. Anas, it sounds like, Anas was saying there's really only about 11 million barrels is the most that they have. And then somebody else, I don't remember if it was you or someone else, said, well, wait a minute. No, they've got more. It's in floating storage, but it's not in Venezuela. It's in Asia. And I'm kind of thinking to myself, oh, yeah, so the Chinese are going to say, oh, that's Venezuelan oil. Send it back. How does this work?
If you're looking at the barrels actually physically off the coast of Venezuela, you're probably looking at somewhere between 10 and 15 million barrels, depending on whose estimate you're using. But it's not obviously the full 30 to 50. You've probably got another 10 or so at various stages of transit throughout the world and floating around waiting to be delivered into China. I think that's probably what is being referred to by the president here, mixed with some additional volumes that have built up on land in Venezuela as part of this attempt to not shut in production. So they've been filling onshore production and or onshore storage in production areas. So I think that's probably what we're talking about. But just again, to reiterate, so far, this volume of oil, it's been taken off the market by Trump in the first place. So this would essentially be a debt almost that's being repaid. So it's only 1 million barrels a day for a month, but that thinking about it another way, you could say, well, that, let's say Venezuela starts producing and flowing again, that could theoretically double Venezuela's supply to the market for 1 month. I think it's another way of framing the same thing, which again, to this point that right now we're feeling a lot of these weird, idiosyncratic, seemingly one-off supply disruptions, whether or not it's Venezuela. We're going to talk, I'm sure, about what's happening in Kazakh flows, the CPC terminal, or Russia or Iran. These are all theoretically supplies that have been lost to the market that the assumption is not that they're going to be permanently offline. So eventually they're not just going to come back online, but in the case of Venezuela's floating storage or built up oil and water, you could theoretically double the pace at which that supplies for a certain number of months.
Okay, so really what we're talking about is Trump took a bunch of oil off the market with his blockade. That oil got trapped in Venezuela. And what he's really saying now is about that oil that I trapped through my military operations and prevented you from exporting, that you've got piled up, however much there is there, and let's inflate it and exaggerate the amount by a President Trump factor. Whatever that number is, we'll take it and you'll give it to us. And that's kind of what's going on there. But it's probably not a full 50 million barrels. Now, meanwhile, in other news, President Trump seems to be encouraging Iranian protesters to continue protesting. And it seems like he's almost trying to, spark a bigger conflict or even civil war in Iran. I think most people are assuming that that is a precursor to some kind of military intervention from the U.S. in Iran. Would you agree with that? Do you think that's what's coming next, and in what time frame?
I think it definitely seems like that's what the market is currently assuming. And I think at this stage, given what we've seen both from President Trump regarding Iran as recently as last summer, where they dropped 14 bunker busters on various Iranian nuclear facilities. And then we obviously saw a fairly unprecedented capture of Nicolas Maduro in Venezuela. I think at this stage, he views those two interventions as wildly successful, as kind of proof of American power, which I think so far has only, and I think will continue to embolden him until one of these interventions goes badly. So I would say at this stage, it seems reasonably likely that the president is going to do something here. And while it's still, if we're just kind of flashing back to this past June when you had the 12-day Israel-Iran war, that's when obviously prices got really spiky again, I think for a good reason. You had missiles flying around the region. But again, I think at this stage, whenever we get to talking about Iran, you're talking about, I think, when we're talking about the price impact, and I think a lot of what we've seen over the past, call it 3-4 days of trading in oil as we've rallied roughly $5 a barrel higher, a lot of that has been Iran risk, particularly running into a fairly overstretched short positioning situation in the oil market. And just for those that don't know, that we're always talking about massive amounts of oil traveling through the Strait of Hormuz. So even though it remains this like really, really minuscule tail risk, I think even a 1%, 2%, 3% move in the probability of something happening in and around the strait is worth a lot to the oil market, particularly in what we'd call this sense of like precautionary demand. So you have these companies, traders, et cetera, that are bidding up the front, particularly the Brent curve, worried about the loss of these barrels. And I think particularly coming at a moment that we're also seeing still tightness in Venezuelan supplies, tightness in Russian supplies, tightness in Kazakh supplies out of the CPC terminal. All these things are keeping the market tighter. And now you have this worry about the situation in the Gulf again. And all of this, if it's starting to sound a lot like 2015, I think you're paying attention. It's the same idea that we have this overarching consensus view of a surplus that's about to hit the market at any moment. It's like this freight train running at you. And then each single month you have some kind of shock that comes in it, whether it's a CPC terminal outage, whether it's the Venezuela blockade, whether it's before that the sanctions by Trump against Rosneft and Lukoil, Russia's two largest oil exporting companies. These things are still having these ripple effects to the market and are keeping all that prompt supply tied up in knots in ways that it's really not able to fully kind of bear down on prices. So again, back to this point of like, is Donald Trump bullish or bearish? I would say, again, he's bullish for prices because absent these knots, we would have a lot more barrels trying to actually clear the market. But as of yet, they're all still, wrapped up in varying degrees of logistical, legal sanctions red tape.
Now, Rory, you are based in Canada. You're a Canadian citizen. I want to ask you kind of an awkward question, which is, look, it used to be that if someone said the United States sometimes engages in regime change operations for the sake of taking oil from countries by removing the government that's in charge and replacing it with a different one, that was just crazy conspiracy talk. It kind of seems like the president's not really hiding the fact that his agenda is very much to take resources, and certainly the folks in Greenland are very acutely aware of this right now, that, he's not afraid to say, look, we think that we should have this. We think it's in the world's best interest. We've decided that it's in the Greenland people's best interest, not necessarily checking with them to see what they think, but just deciding for them. It's in their best interest. It's best for everybody. And it's really important because it's really about the development of the Arctic, including oil exploration in the Arctic. What President Trump is saying is, the United States needs Greenland because if they don't get it, if the United States doesn't get it, then Russia and China will, and it's going to change the balance of power in a way that's unhealthy for the world. And hey, I'm just doing President Trump feels that he's just doing the right thing for the whole planet by telling the people of Greenland that this is in your best interest, even if you don't think so. How do you guys in Canada feel about this, considering that you also have the other big landmass that goes up into the polar region? If you were talking about Arctic exploration, acquiring Canada, in President Trump's words, as the 51st state, would seem to achieve that goal just as well as getting Greenland would. It used to be crazy to think that there would ever be any overt pressure or forced action for the United States to want to annex any part of Canada anyway. For heaven's sakes, we're excellent allies, always have been. What are Canadians thinking these days about all of that?
It's certainly not lost on Canadians, I think, what's happening. I think in a way it's kind of, Canada is both as large, heavy oil resources like Venezuela does, and it has obviously large mining and Arctic kind of territorial expanse, much like Greenland does. So there's obviously a lot of parallels here. I think the way I think about it is a couple different ways. I think on the first, simplest kind of geopolitical lens, yeah, I think if you view kind of North America as your risk board, Venezuela kind of secures your entrance to North America from the south, and Greenland from Europe. Canada is obviously an important piece of that entire continental control. So yeah, that's obviously an obvious point of concern. I think in terms of assuming that, the level, I would say that we still feel relatively safer that our, no matter what opinion you have of Canadian Prime Minister Mark Carney, I don't think anyone believes that he's, the head of a narco-terrorist syndicate. So I think that, you would at least need to create some other pretext there. But I think that what we have seen is this discussion increasing. I mean, the next thing that's going to be bearing on U.S.-Canada relations is going to be the renegotiation of USMCA, or as Canadians call it, north of the border, CUSMA. We put the C at the front, of course, which is, I think, again, your sign of how unified that trade deal was. I think that each of the countries has their own name for the same deal. But that renegotiation is what's going to be coming next. And I think one of the interesting things that's happened over the past year, it was just a year ago that we were talking about how, Trump was thinking about imposing tariffs on Canadian crude oil exports in the United States. And despite pushback from essentially every corner of the industry, they actually did impose tariffs on Canadian crude oil exports for a day or two until the USMCA exemptions kicked in. But I think that there's this feeling of, did Trump feel like reality kind of put him in a bind? I think there was a similar feeling of when he tried to go really hard against China. And then there was this, that rare earths kind of export ban blow up that kind of felt like he got his hands tied by these physical market constraints. I think one of the things that's interesting heading into these renegotiations is, I can tell you many different ways in which Venezuela does not replace Canada in terms of the U.S.'s crude slate, in terms of energy security, et cetera, et cetera. I think what you've seen is amongst the coalition of actors underpinning President Trump, call it the broad MAGA movement, you've seen a very heavy anti-Canada kind of political tone take hold, and particularly after Trump captured Nicolas Maduro last weekend, 2 weekends ago now. Ever since that happened, there were comments around how, oh, now we don't need Canada because we have another country with very, very large kind of heavy oil resources. But just on that, I have to do my Canadian duty to kind of 60 seconds and say that's, you're going to see additional competition in the U.S. Gulf Coast. But those Venezuelan barrels, Venezuela produces less than a quarter of what Canada exports regularly to the United States. It can't get into the Midwest because all the pipelines point south, et cetera, et cetera, et cetera. But I think that what you have seen in the Trump administration is that reality doesn't always bind, as we've seen even with talking about Trump and what he wants international or U.S. oil companies to do in Venezuela. It doesn't really matter what they say. It matters more what his perceived vibe is. And I think right now there's a perception among his coalition that having Venezuela as potentially the 51st state, so Canada would get bumped to, the threat of 52nd state. That I think becomes, they believe that to be a point of leverage. So even if it isn't physically a point of leverage, I don't think that matters. I think that the Trump administration is going to come into these negotiations with a feeling of an advantage in Venezuela they didn't have last time around.
Now, one of the ideas that's been floated by Chris Wright, I think, or maybe it came from President Trump, I'm not sure, was using any oil from Venezuela to refill the Strategic Petroleum Reserve. That actually seems like a strategically good idea to me because the oil that the U.S. is most dependent on, in addition to the oil that's produced in the United States, is blend stock, the heavy blend stock that's needed to mix with that very light Bakken shale oil in order to be able to refine it in our refineries. What do you think about the idea of using Venezuelan oil to refill the Strategic Petroleum Reserve? Is there enough supply from Venezuela to actually do that? Because, of course, the SPR is much bigger than the 30 to 50 million barrels that they're talking about. Is that a realistic thing? And if so, is it a good idea?
I think, to your point, I think that as an example, like this 30 to 50 million barrels, I think, if we're talking about what the most strategic thing the United States could do with it, yeah, I think given that we've consistently talked about how one of the limitations to limiting or to refilling the SPR is the lack of congressional appropriations to do so, the lack of money to actually buy the oil. Well, suddenly, if Trump claims that, Venezuela has, quote, turned over 30 to 50 million barrels, that is roughly market prices, $2.5 billion on the upside, that's the 50, kind of worth of oil, which is actually double the amount they even initially tried to get from Congress in the last kind of big, beautiful bill before it got hacked down to, I think, only 100 and something million. But yeah, I think it's actually it's not a bad idea. The trouble is that, to my knowledge, and I've chatted with a few people that know more about the SPR than I do, but I think to my knowledge, the Mary crude or your kind of heavy Venezuelan crude exports don't really match the spec well of what's in the SPR, which is typically more of a medium sour barrel, more like your Mars or Poseidon barrel, your ASCII kind of blends, if those that are more familiar with the U.S. Gulf. But I think what could be interesting is there is precedent before that the oil that has been, let's say, put into the possession of the United States federal government, in the past, that could be, for instance, through royalty in kind programs where the government actually got physical barrels in exchange for production royalties rather than kind of profits. In prior moments, that has been essentially exchanged, kind of a barrel for a barrel or a barrel for a fraction of a barrel or whatever, for grades that are more conducive to the US SPR. And I think that is an interesting possibility here because obviously the administration has not been very successful at getting those congressional appropriations to refill the SPR. They've had other budget priorities whenever that's been going on. And I think this, given that the Trump administration has so front and center framed this around oil and strategic energy security and everything else, I think that obviously makes sense from a narrative kind of cohesiveness point. But again, I think they would need to do some kind of roundabout maneuver in order to do that and end up with crude that's actually useful to the SPR.
So let's try to bring this conversation around to things that our audience can actually trade. We've got, a pretty, I don't know, it's the first time in how many months that we've not only come off of that $55 very strong support level, but we're above 60, at least as we're speaking on Tuesday afternoon as we're recording this. When's the last time we were above 60 on WTI? Looks to me like we just barely touched it briefly sometime in early December. Before that, it goes off one of my charts I'm looking at. I'd have to look back to sometime in October was the last time before that.
Yeah, I'm looking at Brent the last time. I mean, we're at 65.40 on Brent right now, which the last time we were there was in late October.
Has this rally got legs? Is this the beginning of something big, or is this one of those geopolitical rallies that you want to fade because as soon as the geopolitics calm down, we're going to retrace the whole thing back down to 55?
So my bias here is that it's the latter. It's this geopolitical, again, this is Iran, this is CBC. And again, I keep mentioning the CBC pipeline. So just, again, 60 seconds of what I'm talking about there. The CBC, or the Caspian Pipeline Consortium pipeline, which is essentially the way that 80% of Kazakhstan's oil gets to market. It's a pipeline that comes out of Russian territory that has historically been safer than some of the other Russian ports. But in late November, Ukraine bombed the loading points, the single point moorings that the facility uses to ship on. And essentially that's had this massive blowback effect and kind of taken upwards of a third of Kazakh production off the market in January so far. So there's also this, there's a bunch of these compounding supply losses that are keeping the market much tighter than it would otherwise be. So I'd say all else equal, the assumption is that those will not remain forever going forward, right? That right now, based on the latest number that I'm seeing, you're looking at Kazakhstan's production down to roughly 1 million barrels a day through the first half of January, down from 1.75 million barrels a day in November. So we're talking huge chunky losses. Presumably then Kazakhstan's going to want to get that back up. So as long as Ukraine doesn't continue to bomb the CBC terminal or tankers, as they did today, that were heading to the CBC terminal, that should normalize. But I think the challenge with saying that is that we've been saying that for a little while now, that these one-off things keep happening repeatedly. And I think to a degree, it's useful to kind of just think of just a theoretical regime to talk about what we're seeing right now, which is we have a fundamentally weak oil market, which in my mind has emboldened and facilitated, particularly President Trump, to take ever more volatile, destabilizing policy actions in the market. Yes, eventually this should all roll over and then we get the glut and the prices grind lower and we go fully into contango in the curve. But so far, Trump seems quite committed to continuing to pressure these various countries. And I think as we've seen him emboldened by his at least ostensible thus far success in Venezuela, how far is he going to go in supporting the Iranian protesters? How far is he going to go in pushing harder on Russia? And I think all of this in the context of, I don't know if you saw, Eric, earlier today, but Donald Trump came out and said that he, quote, really wished he could see oil go back down to $53 a barrel again. That's a very, very specific target in the president's mind, which I'll note is $3 a barrel higher than his target used to be. So maybe he is acknowledging his own bullish slant on the market over time.
Well, Rory, could it be that what's going on here is President Trump is trying to do a calculated, risk management move where he says, okay, what he really needs in terms of oil prices is that $53 number that he's talking about before the midterm elections. And therefore, let's go fast and furious, Bill in a China shop, Donald Trump style, do all of the geopolitical upsetting that he might be inclined to do early, get it over with in January, and then give the market time to calm down as we get, into summer driving season and the other pressures that tend to take us back up in oil prices, kind of have it all over with so that we're in the blow-off phase and we're retracing, as you said. Could it be that he's just trying to get all of his geopolitical upsetting done and over with?
I mean, it's not a bad idea. Like if that was actually what if there was a National Security Council meeting or a National Economic Council meeting and like someone said like this should be the strategy, I think it's not a bad strategy because again, I think that this is the period of the year where prices are going to be weakest, when balances were weakest. So that provided you additional fundamental support for doing various supply side destabilizing moves. I think even if you wanted to go one step further, even kind of more galaxy brained here, I think there's a factor that, Trump obviously says he wants low prices, kind of speaking to that consumer sentiment around cost of living and pump price pain, et cetera, et cetera. But I think what you've seen, if you want to be purely rational about it, I've come to really like this theory of essentially this like parabola of political price pressure that when you get over, so there's really compelling research that was done by Brookings that showed negative media mentions that essentially as you get above $3.50 a gallon for US pump prices, negative mentions in media, which I think both reflect and further drive consumer sentiment around these pump prices, builds up rapidly after you hit above 350. But that doesn't, it basically flatlines under 350. Like you don't get this commensurate, it's not like people get happier for $3 or $2.50 gas. So that I think is interesting because your downside payoff is less. It's almost like a prospect curve that the consumers overweight their losses and they don't really give you the benefit of their upside if it's better than that. On the flip side, you have U.S. producers that if they go from $90 a barrel to $60 a barrel on crude, maybe they go from making gangbuster profits to only scraping by. That's obviously unpopular, but it's much more painful to go from 60 to say 40 or 30, where you go from, it's from breaking even to like outright bankruptcy or worrying about layoffs and winding up your company. That becomes much more painful. So I think if you got much below 50 for any durable period, even below 60 for a durable period, as we saw, I think the pushback from kind of Trump's base in the oil sector, which I think has felt reasonably and understandably burned, but I think still naturally gravitates towards his coalition for, let's say, the upcoming midterms. So I think there could be an attempt to kind of balance those competing factions and don't get too offside on either one of those kind of rising parabolas of pump price pain or barrel pain on the producer side. But I think at the end of the day, the one thing I will say is that I think all of this, Trump does so many things and says so many things that I think it's easy to like overfit a theory onto him. But I do worry that this, I think the other side is that I think it's just reasonable to think that he is just kind of winging it, that he wants prices to be lower and, he says that, but he does a bunch of stuff that increases the price with sanctions and everything else without fully recognizing why. And he'll just like post about how if you were a patriot, you would bid the price of oil lower or something like that. So I think I do worry about overfitting and kind of giving him too much credit for having a consistent strategy here because I just don't know if that's the case.
I want to get a little bit more technical here because this is where I think the best trading opportunities are in this market. Last time I had you on, I don't remember how long ago it was, or maybe it was 2 interviews ago, you and I had both noticed something that we thought was quite unusual in the shape of the forward curve, the term structure of WTI crude oil, which is, they call it a curve for a reason. It's usually curved. And what we noticed, both of us, was it's kind of funny. It's like there's really, pronounced backwardation right to one specific contract. I think it was actually right now around January of 26. And then all of a sudden there's like a very sudden bend in the curve and it's all contango after that. And we were both kind of scratching our heads saying, why that specific month? Why not the usual curvature that you would see there? It's happened again, Rory. If you look at the WTI curve right now, it's exactly as you and I predicted. At that time, you and I said, wait a minute, that contango that you see after January of 26, that's going to flip into backwardation, at least at the front of the curve. Well, that's exactly what's happened. But now it's March of 27, so just about 1 year out because, we're just flipping from the February to the March contract and the contract roll that's coming in the next week. All of a sudden, that's the inflection point. Why are these funny shaped curves happening at odd months where all of a sudden that there's that abrupt shift from backwardation to contango? And specifically, what you and I thought at that time was, okay, it means the trade is to buy the spread that started at that time in January 26, by January 26 through January 27, that calendar spread, and expect it to flip from contango into backwardation. Is it would be the H7 H8, the March of 27 to March of 28 1-year calendar spread, which is all in contango. Is that a ripe trade to expect that over the next year to switch into backwardation? And if so, how does that compare with trading the flat price on the front month?
So I think one thing that's interesting that you've seen, and you've seen this almost every month since April, since last April when Trump announced his Liberation Day tariffs. And this is, I think, when this whole, at that point, you got the add-on of OPEC adding all that crude back to the market. This is when the global glut thesis really kind of took hold very rapidly. And what you've seen really interestingly, pretty much every single month since, is that for the first half of the month, the front of the curve weakens. You basically flirt with flipping into prompt contango. And then something happens in the middle of the month, whether or not it's Ukrainian attacks on the CPC, or it's Trump's sanctions against Russian oil majors, or anything else. It's just the moment that you basically get the shock higher. And then basically at the end of the month, you always end back in fairly pronounced backwardation, only for that to begin sliding again the next month. And essentially it's this recycle, it's this yo-yo, up and down, up and down, up and down. Flat prices had, I think, a bit more of a range, like a trend to it. But if you're just looking at prompt time spreads, or even, let's say, the front couple time spreads along the crude curve, that has been kind of a cyclical thing every single month, that it goes lower and then higher and lower and then higher. And I think I've joked with some friends, analysts, they're watching. Someone in the White House is watching for when this curve is about to flip into contango, and that's when they're like, aha, that's when we'll announce the next sanction against Rosneft or Lukoil or whatever. And I think that's something that's been fairly consistent. Now, what's interesting about this cycle is that got started much earlier in the month, about a week earlier than it has in prior months. And this is when Iran kind of got started up. So I think if we were to follow this back to it, if this was to repeat itself, I would expect this, us to remain heavy and hot at the front of the curve up until the end of the month, and then begin to kind of essentially fall back down again as the market says, okay, is this the month when we finally begin to see that surplus arrive on shore? And again, until it's going to happen eventually, it's just a question of how many more months we kick it down the road, because each one of these crises, for most of them at least, it's not a complete change in narrative. It's just essentially you're either delaying that barrel from coming to the market, which means you get kind of a double whammy down the line, or you're just, preventing it from hitting right now. And I think that's what we're going to see, is that these barrels will eventually hit, but we just don't know when. So I think the market's going to keep waiting every single month to say, is this contango month? Is this contango month? And then as soon as something happens, in this case, Iran, and prior cases, it was something else, it was Venezuela, that I think is the cycle that we're going to keep following here.
Rory, I want to come back briefly to this whole regime change question that we discussed earlier in this interview, just because of some news that's happened while we were speaking. Now, of course, the idea that the U.S. would ever engage in regime change operations for the sake of getting the oil is obviously preposterous, ridiculous, crazy conspiracy talk that could never happen. However, just after the market closes on Tuesday, as we were speaking, Chris Wright announces, quote, the U.S. would happily partner with Iran on oil if the regime ends. Now, this is not a regime change operation, of course, but just, hypothetically, if the regime did end, the U.S. would happily partner with Iran on oil. Any comments on that? And as a Canadian, any concerns?
Yeah, I think I haven't even seen the comment come across the line yet, but I mean, it sounds very similar to what we've heard from other, what we've heard from Wright and others about Venezuela. I think there is this definite interest, and I think we haven't even really talked about what these subsidies, or they also talked about potentially putting like equity investments into US oil companies. Like we're going down this weird kind of state capitalist, fusion line that I think is like very unfamiliar to more modern markets, but is like very almost cliche to like imperial markets. And I think that's what this is starting to feel like, is regime change with the kind of the catch of, and we'll kind of get, Trafigura and Vitol or whomever to kind of market your crude for whatever regime replaces you. But I think the thing that we have seen, and I think this is something that has been relatively consistent despite Trump's kind of bravado on foreign policy, is they have not, we're still a far ways away from, say, kind of your Bush era neoconservative democracy promotion, regime change kind of sentiment. That very, very briefly was the thought in Venezuela with getting rid of Nicolas Maduro. Obviously, Marco Rubio, Secretary of State, has been a very, very long-running Venezuela regime change hawk, and I think representing a fairly core constituency of that kind of South Florida vote, whether Venezuelan diaspora or Cuban diaspora populations. But again, what we've seen very quickly there is that, very quickly Trump decided, actually, no, we don't. It would be harder to deal with, say, a new democratic opposition taking power in Venezuela, because that's destabilizing and that's messy and that's hard. So might as well just, even in Venezuela, we're just dealing with Delcy Rodriguez, who is the Maduro's vice president and oil minister, notably here. That I think is, it's easier. Let's just deal with the people we know. And I think there's this question of like, why would that be any different in Iran? So I think right now it's taking this sound of democracy promotion and supporting the protesters. But what we've seen historically from Trump is like a fairly rote willingness to collaborate with whomever ends up being kind of holding the keys to power at the end of this, and which in this case is, would that just be the IRGC or whomever else? Like, it's not necessarily that the protesters are going to automatically get the keys to the government. And I don't know if Trump is interested in the messy, long-term, post-conflict reconstruction work that would be involved with something like that in Iran or Venezuela, which is, I think, right now we're in this moment where this stuff could turn into just like a game of musical chairs, and the next strongman goes into power, and that strongman's a little bit more favorable to Trump in like a very familiar kind of coup to despot that's more favorable to Washington vibe that we've seen from the United States over prior decades. But I think that's not at least what we're hearing from the White House right now. So it'll be interesting to see where this goes. But I don't think that he has the appetite for the kind of follow through that would be required there. And who else is going to be controlling Iranian oil after the Ayatollah falls? I mean, again, I don't think it's any of the protesters at this point.
Well, Rory, I can't thank you enough for a terrific interview. But before we close, I want to ask you to tell us a little bit about Commodity Context, your company, what you do there. I know that you just wrote an excellent piece, really giving your readers a perspective on this whole situation in a little bit more depth than we had time to cover here on what's going on with Venezuela. Could we have your permission to share that with our listeners in the Research Roundup email? And if so, we will share it with them. And please tell us what you do and how people can find out more about your services.
Absolutely. I appreciate you sharing the research. And for anyone that's interested, Commodity Context is a research outlet where I provide all of my thoughts on oil markets evolving as this market continues to roll forward. We've got three main different types of research on Commodity Context, which is a Oil Context Weekly, which is published every week around Friday at 4 p.m. Eastern after markets close. That kind of brings a roundup of essentially what nonsense has happened the week and how oil markets have begun to process it. I've got three different monthly data-heavy reports, which are called data decks, which are on global oil balances, OPEC production, compliance, everything else, as well as kind of a more detailed look around flows around North America. As well as on top of this, I also offer an advisory service to higher touch clients and a data service for those clients as well that want to provide a kind of a deeper data-driven backend that drives my own research. So head over to commoditycontext.com. We'd love to have you, and let's keep following this market together.
And you can find a link to Rory's report on the situation in Venezuela in this week's Research Roundup email. Patrick Ceresna and I will be back as MacroVoices continues right here at macrovoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Rory back on the show. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Rory's picture saying looking for the downloads.
Patrick, Rory had quite a few interesting takes on the market. What's on deck for this week's Trade of the Week?
Eric, coming out of Rory Johnston's interview, the key takeaway for me is that crude oil can look oversupplied on paper, but still trade like as a soft floor because sanctions enforcement and these oil on water bottlenecks keep barrels produced but not fully available to clear in the market. With the market repeatedly respecting the mid to high 50s as a meaningful support zone, I'd rather monetize downside premium with defined risk than try to hero call the direction in a headline-driven tape. So for the trade of the week, I'm looking at a short-dated put credit spread on WTI options. These are the February 17th, 2026 expiry options settling into the March 2026 crude contract with crude oil around $59.80. We sell the $59 put at $2.35 and buy the $55 put for 80 cents. That's a 59 by 55 bull put spread for a $1.55 net credit, or about $1,500 per 1,000 barrel contract. Payoff wise, you're short downside convexity, long carry with a hard defined risk. The max profit is a $1.55 credit if WTI settles at or above $59 at expiration. Your break even is $57.45 and your max loss is $2.45 if WTI settles at or below $55. The max gain versus the max loss doesn't look thrilling if you stare at it in a vacuum, but this is a probability weighted income trade. Using the options market's implied distribution, you got roughly a 62% implied probability of expiring above break even and about a 1 in 4 chance of finishing through the $55 strike where you're at a max loss. The bottom line, you're getting paid to take the view that over the next 30 days, that $55 to $60 level acts like the market's floor.
Patrick, every Monday at Big Picture Trading, your webinar explains how retail investors can put on our most recent Trade of the Week. For those listeners that want to explore how to put on these trades in greater detail, don't miss out on a 14-day free trial at bigpicturetrading.com. Now let's dive into the post-game chart deck.
All right, Eric, what are your thoughts here on equities?
Well, Patrick, I put on the S&P hedge that you recommended in last week's Trade of the Week, and I agree with your analysis that you gave then. The trend is very clearly up, but positioning is so crowded that it wouldn't take much to bring on a sharp correction. So I think that protection makes lots of sense up here.
Well, Eric, I want to continue to build on last week's conversation about the underpinning sector rotation that's getting underway. On page 4, I'm showing that chart of the Mag 7 ETF, which has continued to deteriorate as we're having these big mega caps continue to have selling pressure. But the newest development is that the earnings on these financial stocks like JP Morgan and Bank of America have started to come out, and the financial sector ETF has clearly broken to the downside, attempting to derail one of the sectors that has been the leadership over the last few months. So the big question here is that if we are seeing this pressure on the Mag 7s, but the earnings start to create disappointment in some of the leadership spaces, does that leave the window open for a deeper S&P correction? We'll be watching right now the 6850 to 6900 level on the S&P futures is that line in the sand level I'm looking where retracements, so long as they're being bought on pullbacks, then we want to just acknowledge that the bulls remain in control of this trend. But any technical breakdown there could cause many of the CTAs and other systematic traders to begin some sort of a profit-taking cycle that could usher in a first quarter market correction. We'll certainly see how these earnings start to play out over the next few weeks. All right, Eric, let's touch on that US dollar.
We've taken out the 200-day moving average to the upside and are setting up for a golden cross now. So without a doubt, the clear and established downtrend is changing to something else. But as far as I'm concerned, the jury is still out in my mind as to what that something else is, whether it's really a direction change to a new uptrend or even here at 99 on the Dixie, we're flirting with 99 as I'm recording this. Is it really a trend reversal, or is it just a broader consolidation pattern forming? The reason that I'm not sold on the idea that it's a trend reversal is President Trump's bold geopolitical moves. Let's not use dirty words like regime change or annexation here on the show. Those are definitely dollar positive short-term influences. So the question in my mind is whether that recent dollar strength that we're seeing is really a trend change or just a reflection of the geopolitical headlines. And if it's the latter, it's likely to retrace and we're likely to resume the downtrend when and if the president shifts from his usual in-your-face power bluff to actually making a deal, which he almost always seems to do. So let's give this time and see how it plays out. But definitely the downtrend that was strongly in place is giving way to some other pattern. Let's see what it turns out to be.
Well, over the last few weeks, we definitely have seen that U.S. dollar get back above some key moving average. So really, though, we do need to step back and look what the dollar did in the last 6 months. I mean, after a very nasty drop in the first 6 months of 2025, the dollar spent the last 6 months in a tight 3-point trade range. We are still in the middle of that trade range. And so closes above the moving average certainly are early stage signals. There needs to be meaningful bullish follow through for there to be a big upside on the market. But the one thing we want to keep emphasizing, it is very consensus view that the US dollar is going to weaken. And so the pain trade definitely is the US dollar having an up impulse. Will that materialize? This kind of 99 to 99.5 level is the Fibonacci zone. And if it's cleared, it certainly could be the first part of where we see some bullish follow through on there. But at least for now, I'm looking at this 98 to 99.5 as a neutral zone. And I'm not trying to take any strong positioning without a clear trend being established here out of this trade range. All right, Eric, let's take a look at that oil chart.
Well, obviously, we covered the big picture on oil. It was the whole feature interview, so I'm not going to belabor it too much here in the postgame segment. I'll just say briefly that the price whipsaw that we saw on Wednesday afternoon coincided with fresh statements from President Trump that he might not need to interfere militarily in Iran after all. So that's the reason that Rory's prediction came true, that the big upside move that we've seen in crude oil in the last week had more to do with geopolitical headline risk and that geopolitical risk premium than it had to do with any new fundamental trend. So the next move from here will be headline dependent. Clearly, we do have a big enough upside move that, it could have triggered a technical signal that a new uptrend is in play. I'm fading that signal because I think this is headline driven.
I won't disagree that it will be headline dependent, but let's just make some key observations. What we have seen here in the last month is some pretty negative news towards crude oil, but every time we had a down sequence on oil, it was immediately bought on dip. So there's clearly a base and a support line being established technically. Now, while obviously whether or not oil squeezes to like $70+ would certainly need to be headline driven, at least at this moment, it's clear that there's some sort of a base being established. Let's see if that holds over the next few months. All right, Eric, we got to touch here on gold. It's been ripping to new highs. What are your thoughts here?
Well, just as we predicted last week, this past week did in fact see a fresh new all-time high in the gold market, and that activated measured move targets to somewhere between 4,900 and 5,100 to the upside. But a lot of the upside that we've seen in the last week was geopolitical risk premium, and as with the oil market, if the Iran military strike speculation dies down as the president tames down his rhetoric a little bit, we're likely to see a downside retracement, giving back at least part of this upside that we've seen over the last week, which has been quite significant. And to be sure, we're back into overbought territory on the stochastics as well. So if that geopolitical premium evaporates, there's plenty of room for a significant short-term correction before this bull market eventually continues. But I'm convinced that it eventually will.
Well, I have to agree with your upper targets. Mine are just a little bit lower, like 4,800 towards 5,000, but clearly gold continues to run. We have silver making new highs, platinum and palladium attempting to break again to a fresh new 52-week high. And so these markets are hot, they're running, and there's zero evidence that the wind has been taken out of the sails. So right now, the path of least resistance is higher to some of these upper targets. The one thing I want to note on silver is that we've really entered a parabolic phase where, we're seeing these $5 swings higher on a daily basis. Whenever this type of parabolic move happens, it certainly can go higher here on the short term, but it feels like there's going to be some sort of a blow off. Maybe it happens at the $100 plus level on silver, but there's likely here to be some exhaustion point where silver is going to have a period where it has to settle in the price after such an extraordinary rip on the upside. Now, I wanted to quickly just touch on this copper chart. We're trading at 52-week highs. I've got upper targets around 640, 650 on the upside. We continue to see the copper markets being very well bid. There's no immediate sign that they've topped out. So let's see whether they can finish off these measured moves to the upper targets. All right, Eric, let's touch on uranium and uranium stocks here.
The structural rally in uranium and uranium miners is clearly on. Even the URA ETF, which has lagged the other ETFs because of its high concentration of small modular reactor company names, just barely closed on Wednesday above the 61.8% fib retracement level of its recent correction. That was the last technical signal that I needed to see for confirmation that this move to the upside is on, and it's on strong. Now, the short-term stochastics are still overbought, so we might need to consolidate here a bit longer. But I definitely think that the move is on to considerably higher prices, and I have a very strong confidence at this point that uranium is going to be the big winner, the big trade of 2026. So I have a very heavy concentration of longs with considerable size in this market, and I'm very optimistic about what 2026 will bring. Patrick, before we wrap up this week's show, let's hit that 10-year Treasury note chart.
It's been incredibly quiet. We got our first wave of data, jobs numbers, CPI, PPI, retail sales, and nothing seems to be at least starting any new trend. We remain in a very tight range. There's every opportunity for yields to move in a big way at some point, but right now they stay in this purgatory waiting for some sort of a catalyst to begin the next big repricing. We'll see what that is and when it starts.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, as well as the Trade of the Week chart book we just discussed here in the Postgame, including a number of links to articles that we found interesting. You're going to find this link and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main account on X at MacroVoices for all the most recent updates and releases. You can also follow Eric on X at Eric S. Townsend. That's Eric spelt with a K. You can also follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests, and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.